Imagine you're an IT consultant earning $180,000 a year. You set up a company. Your clients pay the company instead of paying you personally. After business expenses, there's $150,000 left. So you think, great. Instead of paying tax personally, my company can pay company tax and keep the remaining profit. Sounds smart. But there could be a problem. The auto may look past the company and ask one very important question. Who actually earned this money? If that $180,000 was mainly generated from your personal skills, knowledge or efforts, the income may be classified as personal services income, or PSI. And yes, income can still be PSI even when the client pays your company, trust or partnership. Let's go back to our consultant, Sarah. Sarah Consulting Proprietary Limited has the contract. It sends the invoices, it receives the money, but Sarah personally performs almost all the consulting work. Without Sarah's expertise, there is effectively no income. That's exactly why PSI needs to be considered. But here's where many people get confused. Having PSI does not automatically mean the PSI rules will attribute the income back to Sarah. There is another question. Is Sarah conducting a personal services business, or PSB? One of the first things to consider is the results test. Broadly, this looks at things such as: is Sarah being paid to achieve a specific result rather than simply for her time? Does she provide the tools or equipment needed to perform the work, where applicable? And is she responsible for fixing defects in her work? If the requirements are satisfied for at least 75% of the relevant PSI, Sarah may be able to self-assess as conducting a personal services business. But what happens if she doesn't pass the results test? Now things get more interesting. You may have heard of the famous 80% rule. If 80% or more of Sarah's PSI comes from one client and its associates, she generally can't simply rely on the other personal services business desks to self-assess. And here's something many contractors misunderstand. The 80% rule is not itself a personal services business test. It's essentially a gateway that affects whether you can self-assess using the other tests. So let's return to Sarah's $150,000 profit. If the income is PSI, Sarah doesn't qualify as conducting a personal services business, and the PSI rules apply. The net PSI can potentially be attributed back to Sarah personally. There may also be restrictions on deductions and pay withholding consequences, so the lesson isn't, don't use a company. Companies can be extremely useful structures. The lesson is, don't assume that using a company automatically converts income generated by your own work into company profits taxed at company rates. When you're a contractor, start with one question. What is actually generating the income? The business, employees, assets, a scalable system, or mainly you? Because when the answer is your personal labor, expertise or skills, PSI should be considered. And in the next video, we'll break down the 80% rule, one of the most misunderstood parts of Australia's PSI regime. If you want practical explanations of Australian tax, investing and wealth strategies without unnecessary complexity, subscribe to Trustify. We turn complex financial concepts into practical ideas you can actually use. This content is general information only and does not constitute tax, legal or financial advice. Individual circumstances can significantly change the outcome.